Hello class 12 and welcome to your economics class. I'm your Nigam sir and again I have come up with another video and today we are going to study about another chapter that is balance of payments and exchange rate. In this video the lesson that we are going to study is the meaning of balance of payment and its different components. Before we go on to the topic, we should know that in modern economy, all the countries all over the world engage itself in economic transactions with other countries. So those economy which engage itself in economic transactions with other countries is known as open economy. No countries in the world are self-subsistent, so they have to depend upon other countries for different goods and services. So in this regard, the government of every country keeps account of its economic transactions with the other countries of the world. The record of economic transactions among different countries is known as balance of payment. So what is the meaning of balance of payment? Balance of payment is a systematic record of all economic transactions between the resident of one country and the resident of foreign countries during a given period of time. So what is the main objective of keeping a record of international transaction is to provide information to the government as well as other relevant agencies about the international position of trade and capital flows of the country. It also shows the economic condition of the country. Now, we will understand about the components of balance of payments. There are altogether two components or two sides of balance of payments. They are the credit, that means in credit side we normally enter the receipt items, and the other component is the debit, which means the payment. So whenever a country receives anything from the foreigner, then that item is termed as credit. And whenever any person pays to the foreigner, that item is known as debit. So in other sense, we can simply say that balance of payment is a system of listing all of these items on the credit side and the debit side. So another thing that we should know in this video is that the balance of payments are usually categorized into two groups, and these two groups are current account and the capital account. So in the balance of payments, two accounts are maintained, that is the current account and the capital account. Now let us understand what are current account and capital account. The current account records all international economic transactions that are relating to exports and imports of goods, services, unilateral transfers, and international incomes. So, what are the items included in the current account are export and imports of goods. So, the first item that we enter in the current account is the exports of goods and the imports of goods. The second item is the services of a bank, the services of an insurance company, and the services of shipping, etc. The third item is the unilateral transfer. Unilateral transfer are all those items or are all those items for which no corresponding return is there. For example, gifts, donations comes under the unilateral transfer. Whenever any government gives a monetary help to another country, then the other country does not pay anything in return to that country. So that is what is known as unilateral transfer, where no corresponding return is being made. and sometimes it is also called there is no quid pro quo in case of unilateral transfer, which simply means that there is no return, there is no corresponding return when these unilateral transfers are being made. The fourth item is the income. So what comes under the incomes are the interest, dividends, profits, etc. The another account that is maintained in balance of payment is the capital account. So what do you mean by capital account? Capital account records all international economic transactions that is related to the change in assets, that is both financial as well as physical assets. So what are the different items under the capital account are the loans which is given by the government to another government or to another individual, or the loan that is taken by the domestic country, by the domestic government from other sources, from the international sources like from foreign governments, from foreign public, or from foreign international institutions, financial institutions like IMF, World Bank, Asian Development Bank, etc. The second item that are included in the current account is the purchase and the sales of assets, that is the purchase of land, the purchase of houses, plant, sales, etc., and also the sales and also the sale of all these items comes under the capital account. The third item is the stock of gold, silver, foreign exchange reserve, etc. So the purchase and the sale of gold, silver, foreign exchange, that is foreign currency, also are entered under the capital account. So these were the different items of current account and the capital account. Another point to be noted out here in the capital account is that all these items in the capital account are classified into two categories, that is direct foreign investment and portfolio investment. So what do you mean by direct foreign investment? Direct foreign investment refers to the investment undertaken in the firm belonging to other countries by acquiring control over them. For example, a foreigner might undertake direct investment in our country either by setting up a factory or by purchasing an Indian firm or an Indian company. So that is an example of direct foreign investment. Or it can also be so that an Indian can purchase the foreign company or might set up a plant or a factory in a foreign company. So that is also an example of a foreign direct investment. For example, an Indian buying a Bangladeshi company in Bangladesh. So that is an example of direct foreign investment. Another type of investment is portfolio investment. Portfolio investment is that form of investment under which the companies or the resident of a country purchases the shares of a foreign company or buys the bonds issued by the foreign government. So that type of investment is known as portfolio investment. For example, I being an Indian can buy the shares of a company of Bangladeshi company. Understood? Or I may also buy the bond issued by a Bangladeshi company. So in this portfolio investment, the one who purchases the shares of the bond do not have full control over the company. So that type of investment is known as portfolio investment. Now let us understand, this is how the balance of payments looks like. One, we have two columns, that is the receipt or the credit column, and another is the debit or the payment column. And there are two accounts, that is the current account and the capital account. Usually in the current account, the exports where there is inflow of goods, whenever there is export of goods, there will be inflow of money from foreign country. So that is always entered in the credit side. And the other hand, whenever there is import of goods, then we have to make the payment to the foreign country. That is why import of goods is entered on the debit side or on the right side of the balance of payment. Similarly, the exports of services, unilateral transfer, income receipts are entered on the credit side or the left hand side of the balance of payments, where there is inflow of foreign money to our country, that is in the domestic country. And on the other hand, the import of services, unilateral transfers, income payments like the dividend payments, profit payments, all these payments comes under the debit side of the balance of payments, where there is outflow of domestic currency to the foreign country. Another account that is maintained, like we discussed earlier, is the capital account. And in the capital account, normally the capital receipts are entered. That is, whenever the country borrows money, or whenever the country sells its assets like building, land, gold, etc., then that items are mentioned or entered in the capital receipts. And on the other hand, we have the capital payments, and under this capital payments, usually the lending by the foreign government is entered. Not only that, whenever there is purchase of assets like shares, bonds, land, gold, silver, all of this purchase where the payment is being made, where there is outflow of money from India to the foreign country, that items are mentioned in the capital account. So this is how the balance of payment of any country looks like. We have come to the end of video. I hope it is clear, and thank you for watching.